Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're unpacking Merck's Q2 2025 performance. And it was quite a quarter, presenting a really fascinating, maybe even perplexing picture sometimes.
Yeah, definitely.
Our mission for you today is to cut through the noise from that earnings call, really distill the key takeaways, and help understand why the market reacted, well, pretty cautiously.
Indeed. What we saw from Merck, it's sort of a classic mixed bag, a beat on one key metric, EPS, which gave a bit of hope. But that was really overshadowed by a miss on revenue that, ultimately grabbed the market's focus.
Right.
There are clear strategic moves happening, but also some pretty significant headwinds they're navigating. Explains that cautious tone.
Okay, so let's get straight to those core numbers that set the stage. Merck reported non-GAAP EPS, that's earnings per share adjusted, for a clear operational view at $2.13.
Which comfortably beat the LSEG consensus estimate. That's the London Stock Exchange Group analyst's view.
Exactly. But the revenue side, that tells a different story.
A more complex one, yeah. Sales came in at $15.806 billion, just shy of what analysts expected, and it actually represented a 2% year-over-year decline.
Down 2%, okay.
So this immediate mix, EPS beat, revenue miss, it saw shares take a noticeable drop right after the announcement, and they faced pressure through the trading day. It wasn't just the top-line miss, though.
No.
It signaled deeper investor questions, particularly around a certain vaccine's performance, Gardasil, and also how effective this new cost optimization program really is. The market, you see, is looking hard at the underlying story.
Okay, diving deeper then, beyond those top lines. The product portfolio reveals a lot of that mixed picture, explains the reaction. Keytruda, their oncology blockbuster, is still incredibly strong. It grew 9% to bring in almost $8 billion. $7.956 billion, actually.
Still the engine. And animal health looks solid, too, up 11% to $1.646 billion.
And that newer launch, Winrevair, already adding $336 million, so some real drivers there.
But the headline grabber, the big concern was Gardasil.
Yep.
Sales for the HPV vaccine plummeted. A staggering 55% down to just over $1.1 billion.
55%. Wow. What was the reason given?
Management pointed primarily to an extended shipping pause in China. They were pretty clear. They noted Gardasil China is now less than 1% of total company sales, and they're de-emphasizing it for future growth.
Quite a shift from what was a major growth engine. Really shows the volatility, especially in some international markets.
Absolutely.
Okay, on the profitability side, how did margins look, especially with that revenue dip?
Margins were actually quite strong. GAAP gross margin at 77.5%, non-GAAP even higher, 82.2%.
Solid numbers.
Yeah, and GAAP tax rate 11.4%, non-GAAP 15.0%. But the market's focus, it clearly went beyond just this quarter's profit to the longer-term growth story.
Which brings us to that strategic imperative they talk about, replacement power.
Exactly. This quarter really highlighted it. Diversifying the portfolio, finding new revenue streams to replace Keytruda's massive sales as we get closer to that expected loss of exclusivity in 2028. It's about future-proofing the whole business, essentially.
And we saw moves there, right? M&A activity.
Significant M&A, yes. The SpringWorks acquisition just closed July 1st. That brings in Ohtuvayre and Gomechi. They generated $82 million combined this quarter. And Ohtuvayre alone was up a stellar 52% quarter on quarter.
Okay, that's strong growth out of the gate.
And the Verona Pharma acquisition that's bringing Ohtuvayre for COPD is targeted to close in Q4 this year. Tangible steps.
And to fuel all this and improve efficiency, they also unveiled that big multi-year optimization program.
Right, aiming for about $3 billion in annual savings by 2027.
$3 billion. It's not just trimming fat. That sounds like a serious war chest, maybe funding that post-Keytruda future, preparing for those patent cliffs.
It's certainly ambitious and necessary, you could argue. The pipeline news also gave some positive signals that this investment is maybe starting to bear fruit.
Like what?
Well, ENFLONSIA for RSV in infants got FDA approval and that critical ACIP recommendation.
The ACIP nod is important for uptake.
Very important. Sets it up for broad use. We also saw positive early phase 3 results for Coral Reef, and detailed phase 3 for pimictinib showed significantly improved response rates. Launch planned for 2026 there.
Okay.
Even early data, phase 1B for the anti-TIGIT ADC M9140 looked encouraging. These are the kinds of new assets, for you listening, that are absolutely crucial post-Keytruda.
So looking across the business sectors, it really sounds like a tale of two cities this quarter for Merck.
It kind of was, yeah.
Life science, for instance, saw its organic sales growth guidance for the full year upgraded, now plus 3% to plus 6%.
And within that, Process Solutions was, well, stellar. 11.5% organic growth. Order intake comfortably above 1, they said. That suggests customer destocking is finally behind them. Robust demand.
That's a very positive signal from that part of the business.
Definitely. But not all segments shared that optimism. Science and Lab Solutions, or SLS, was flat organically.
Still struggling.
Still grappling with U.S. policy changes affecting academic and government labs, plus muted demand in China's lab market. Management did mention some green shoots with pharma and larger biotech customers, but its recovery is still a question mark.
Okay. And healthcare.
Healthcare delivered solid 3.6% organic growth, largely driven by Mavenclad, actually. Mavenclad posted really impressive 20.7% organic growth, particularly strong in North America, a reliable performer.
Right. But then there's electronics.
Yeah, electronics face significant headwinds. Organic sales down 5.6%. Semiconductor materials kept growing, low single digits, but it couldn't offset this huge, more than 30% organic decline in the DS&S business.
DS&S being delivery systems and services.
Correct. And that's mainly due to customer project delays that are now apparently stretching beyond 2025.
Beyond 2025. Ouch. That suggests a pretty long slowdown for that sector.
It does. And the segment also had 2 one-off items in Q2 that really clouded its profitability. A low double-digit million euro non-cash adjustment, sort of an accounting thing from a prior acquisition PPA. And a mid-double-digit million euro provision for customer compensation due to an old supplier mislabeling issue.
So hitting the bottom line.
Yeah, those 2 alone knocked about 7 percentage points off the electronics EBITDA pre-margin. Its profitability before interest, tax, amortization, a significant drag.
All right, so pulling it all together, what's the updated outlook for the full year fiscal 2025?
They updated guidance, projecting sales between $64.3 billion and $65.3 billion, and non-GAAP EPS in the range of $8.87 to $8.97. The assumption of that $200 million tariff headwind, that stays the same.
Okay, that tariff cost baked in.
Yep. And segment guidance reflects these mixed trends we've been discussing. Life science organic sales growth upgraded, as we said.
Yeah.
Healthcare organic sales growth range was narrowed, but its EBITDA pre-organic growth guidance actually went up, partly because they sold off an FDA priority review voucher.
Now, monetizing that voucher, those can be valuable.
Exactly. Speeds up review for another drug. But electronics, its organic sales forecast was revised down significantly, as was its EBITDA pre-guidance, reflecting those persistent delays.
Makes sense.
And the company expects R&D costs to gradually increase, ratio around 20% of sales in the second half, especially with SpringWorks coming on board.
So as you look ahead, second half of 25, what are the key things to watch?
Key checkpoints, definitely the Verona acquisition closing. Any signs of Gardasil demand stabilizing or continuing to be weak?
Yeah.
How Keytruda keeps growing in those earlier stage cancer settings, and ENFLONSIA's uptake during RSV season. And of course, you always have to watch the evolving policy headlines around Medicare, pricing dynamics. That's always a factor.
Always working. So despite that EPS beat, despite all the strategic activity, M&A, cost savings, the market reaction was, well, undeniably cautious.
It really was. And what's fascinating here is the skepticism underneath it all. Investors aren't just looking at the numbers this quarter, they're scrutinizing the narrative, the long-term story Merck is trying to tell.
Exactly. You saw analysts raising concerns about Gardasil's credibility long-term, suggesting the pain might drift into 2026.
Oof.
There's clearly demand for a more defined post-Keytruda growth path, not just identifying new assets, but showing how they fit together. And that big question, will the $3 billion in cost savings really fund future growth, or is it maybe masking some underlying issues?
Which raises that important question for you, the listener. In this current healthcare landscape, with U.S. pricing pressures, China demand normalizing, how effectively can Merck's replacement power strategy really offset these big challenges? The market signal seems to be sustained outperformance needs immaculate execution on these new launches, and tangible proof that the optimization program truly accelerates a durable multi-asset growth mix, not just propping up margins for now.
All right, quite a complex picture. Let's switch gears now, maybe something a bit more speculative, but rooted in what we've discussed. Time for our This Is Not Financial Advice segment, an outrageous but plausible trade idea.
Okay, given all these Merck complexities in Q2, here's a thought. A biopharma resilience pair trade. The idea is Go long Merck equity, specifically targeting the strength we saw, and they projected, in its life science process solutions segment.
Okay, focus on the strong part.
Right. Organic growth upgraded, customer destocking seems over, that book-to-bill consistently above 1. It looks like a robust engine inside Merck's diverse portfolio. Fundamental demand seems there.
All right, so long Merck focused on life science process solutions. What's the other side of the pair?
Simultaneously, consider a short position on a smaller, maybe pure-play competitor, specifically in that struggling electronics delivery systems and services, the DS&S sector.
The one where Merck saw the big decline.
Exactly. Merck's own DS&S business dropped over 30% organically, project delays stretching beyond 2025. That points to a prolonged, sector-specific slowdown. It's likely to hit less diversified players, those with less capital to weather it, even harder.
Interesting logic.
So the trade tries to capitalize on Merck's internal diversification, that stark contrast between its divisions. It could hedge against broader market swings while trying to exploit a specific sectoral weakness for you.
A plausible, if perhaps outrageous, idea. Remember, folks, just an idea, not advice.
Absolutely not financial advice.
And that wraps up our deep dive into Merck's Q2 2025 earnings. A quarter really defined by, well, Keytruda holding strong.
A surprisingly tough Gardasil performance.
And that very clear strategic pivot towards diversification and efficiency, building for the future.
And the market's cautious reaction, it just underscores how important execution is now. They need tangible evidence that Merck can build that durable growth profile after Keytruda. Definitely keep a close eye on those H2 2025 checkpoints we mentioned. They'll be critical signals.
Indeed. So the real question for Merck isn't just if they can diversify, but maybe how quickly they can convince a skeptical market that these new assets aren't just filling a gap, but actually building the next wave of blockbusters.
Will 2026 bring relief for Gardasil or more of that pain analysts talked about?
Something for you to ponder as you watch Merck navigate its path forward. Thanks for joining us on the Deep Dive.
We look forward to our next exploration.